The next tranche for sovereign gold bond comes up for redemption on August 5, 2024, 8 years after it was launched on August 5, 2016, at a buying price of almost 3,119 per gram. Well, 2.6 tons were bought, of which nearly 225 kgs was redeemed at that time, and after 5 years, leaving 2.75 tons due for redemptions now. And then immediately in the next month, in September 2024, would witness 2.4 tons of redemption, making it a total of 5 tons coming in for redemption in just about 2 months. The September 30, 2016 tranche was bought at 3,150 per gram. As of today, investors have gained 2.5% per annum interest on their investment in all of these last 8 years, and the prices itself have gained up by 115% to near 6,800 rupees per gram. The prices in the global markets have corrected, and the 9% import duty cut in India also has led to correction in the Indian markets, bringing the prices down from its all-time high of 7,500 per gram and from the budget day high of 7,250 per gram. But even with this, there is a triple-digit gain to the investors of these 2016 tranches. Currently, in total, 64 issuances done between 2016 to 2024, with about 141 tons are outstanding for redemptions. The latest tranche was announced in Feb 2024, which will now come for redemption in 8 years, which is in 2032. Well, with India imports at approximately 800 tons per annum, and the import duty cut from 15% to 6%, the Indian government stands to lose 12,000 crore per year with that. But it does gain a bit by the upcoming 5 tons redemptions. A rough calculation says that per ton government will save 59 crores. So if you look at 5 tons, that comes to 59 crores. When the sovereign gold bond scheme was started in 2015, the customs duty was 10%. It was increased in 2019, 2021, and in 2022 came to a total of 15%. The duty hikes did lead to increase in profits for investors, and so did the government liability in sense of redemptions. The distorted duty structure and all-time high gold prices did lead to increase in instances of unofficial gold coming into the country, leading to government slashing the import duty during this budget. The sovereign gold bonds are government securities denominated in grams of gold. They are substitutes for holding physical gold. The SGBs offer a superior alternative to holding gold in physical form, and they have a long list of positives. Investors are assured of the market value of gold at the time of maturity and periodical interest. SGB is free from issues of making charges and purity in the case of gold and jewelry form. The bonds are held in books of RBI or in demat form, eliminating risk of loss of scrip. On maturity, the gold bonds shall be redeemed in India rupees, and the redemption price shall be based on simple average of closing price of gold of 3,999 purity of 3 days from the date of repayment, published by the India Bullion and Jewellers Association. Well, these securities are eligible to be used as collateral for bank loans from banks, financial institutions and NBFCs. Interest on bonds will be taxable as per the provisions of income tax, but the capital gains tax arising on redemption of SGBs to an individual have been exempted. The bonds are tradable from the day to be notified by RBI. The bonds can also be sold and transferred as per provisions of Government Securities Act 2006. The partial transfer of bonds is also possible, making it the much sought financial instrument when it comes to buying gold.